to Follow the Money.
Welcome everyone to Traders of the World, our new interview show where we bring inspiring stories about the financial market and incredible guests. I am Matheus Massari and I am extremely excited to be here. With me, I have Flavio Lemos.
Thank you, Matheus. Hello, world. Good morning, good afternoon, or good evening, wherever you may be around the world. I'm Professor Flavio Lemos, chairman of the Brazilian local chapter of the CBT Association, also author of some investment books, and we are speaking English because we want this show inspire new traders around the world. I hope you like it and subscribe to our channel.
Great, I'm certain that we will have an amazing conversation with our guest. Speaking of our guest, he began his career in the 80s on the CME trading floor and spent the next 70 years there acquiring a practical, real-world education on how the US financial markets works from the inside out. This experience early in his career became the foundation for his unique analytical approach and understanding of what really drives the financial asset prices. His proprietary blend of technical and quantitative inputs and Asbury Research's quantitative model are more forward-looking, agile, and actionable than the typical Wall Street approach. Flavio, is he a CMT member?
Yes, he is. John was awarded the CMT designation in 1999, served as vice president of the CMT Association from 2004 to 2006, and was a member of its board of directors from 2002 to 2006.
He is the chief market strategy of Asbury Research, a firm that he launched in 2005. John has more than 40 years of experience studying, analyzing, and forecasting global financial markets. Asbury Research provides data-driven technical and quantitative investment research and to professional and private investors. Please welcome Mr. John Kossar.
Hi, everybody. It's good to be here. Thanks for having me.
Thank you so much for you being here, John. John, so tell us about your beginning on the floor of the CME. Up from the start, what did you learn to do there and not to do there?
Sure. I started there by accident. I was in my early 20s and I was working construction and I didn't like it. And I wanted to do something else. And I was a weightlifter back then. And one of the guys that I used to see in the gym, we used to talk, spot each other at the gym. And I found out that I saw him get into a $60,000 sports car one day. And I asked him what he did for a living. And he said he was a broker on the Chicago Mercantile Exchange. And he asked me if I wanted a job. And I said yes. I quit my job that day and I was on the train with him downtown the next day and started as a runner. Back then, runners made $100 a week. So I got a job tending bar for 3 or 4 days a week because I had a car and I had an apartment. And I fell in love with it almost immediately. It was obviously really a vibrant place to work. There was 3,000 people on the floor at the time. And I stayed there 17 years. I think I did every possible job down there except the guy sweeping the floor after the day was done. I literally did everything there. And I learned practical money management and trading rather than the academic side, coming up from the academic side or the theoretical side where you're looking at the economy and you're looking at earnings reports. This was very much trying to read the pit, trying to see what the investor sentiment was, by your ear, just by being able to hear it on the trading floor and being able to learn how to calculate in your head when you put a trade on how much you were risking for how much you were making. So there was a lot of nuts and bolts kind of practical trading experience that I had there that unfortunately that's gone. The trading floors are, for all practical purposes, they're gone now. But back then, somebody like me that was hungry and wanted to learn a trade and was interested in the financial business, that was just a golden opportunity right in 1980s. That's when they launched the IMM, the International Monetary Market. They started trading foreign currencies on the floor. So it was really a gift that this person Jack gave me, just to allow me to go there and find something that I love to this day. I mean, I love getting up in the morning every day and looking at markets.
This history remembers the Will Smith film.
Yeah. All right.
Yeah.
Pursuit of Happiness.
Pursuit of Happiness, because he saw a guy with a Ferrari
Yeah.
enter in some bank or something like this. What to do to get this car? I wanna do the same.
Yeah.
Very close. Maybe the film was inspiring you, not.
All right. So, John, as an experienced trader, you must have many rights and wrongs. So, what was your best and worst trade, and what have you learned with it?
Well, I can tell you my worst beating that I ever took in the market was I started on the trading floor and I immediately got interested in charting. So I used to do all my charts by hand. I would do them after I came home from the exchange. And, when you ran out of space on your chart, you got some Scotch tape, right? And you taped another piece and you kept charting along. So nobody ever got to eat on my table in my kitchen because that's where my charts were. But I started to develop a little following on the floor. I started to put some chart points on some of the trading cards. They had the trading cards on the floor, and I'd sell them to the brokers. This was before I had my badge down there. And I started to think I was pretty smart, and I had a following down there on the floor. And I was looking at a stochastic, just simply a stochastic, which tells you overbought and oversold. But what I didn't know at the time is they don't work very well when the market's trending hard. And this was like probably 1984-ish, maybe 1983. So one of the guys that subscribed to my little service that I had, he traded the live hog market. He was in his 80s, and he kind of adopted me as like his grandkid. And he invited me to come up to his office and trade with him. And during this bull market, he kept seeing me trying to sell the highs in the S&P, right? Because the stochastic was overbought. So one day, he reaches in his pocket and he pulls out a quarter, 25 cents, and he hands it to me. And he goes, I want you to go downstairs and buy a Wall Street Journal. And I go, why? He goes, it's a bull market. He goes, buy the Wall Street Journal. So that was like slapping me right in the face, right? Here I was this guy that was selling my ideas, and he goes, everybody that can afford a Wall Street Journal knows it's a bull market except you. Go buy one.
You are trying to get the tops.
Yeah.
That was my lesson. I just learned.
Yeah, what a great lesson.
Trading, these tools are like if you're building a house, right? A screwdriver is a great tool, but not a good tool if you're trying to hammer a nail. And that's really how these tools work. You have to know which tools to use for which job you're doing in your trading.
So, John, what's your personal style as a trader? Do you day trade, swing trade? Do you buy and hold and follow the trend? What's your personal trader's routine? Could you explain in details how is your trading process?
Sure. That's another good question. When I was on the trading floor is it's just, a lot of it is pure emotion, right? You see the guys jumping up and down the pit. There's a lot of macho going on there. There's a lot of testosterone on the floor. There's a lot of emotion. I was not good in that environment. I was not, because you start bumping chests with people, right? And showing who's more convicted in the trade rather than, using this. Too much of this and not enough of this on the floor can really get you hurt. So right now, it's totally data-driven. What I've really changed since I've come off the floor, we look at money flowing in and out of the ETFs. We're looking at relative performance between different indexes, volume, market breadth. So my son, Jack, who works for me, and I have built some models that I'll show you as we get into the interview, if you like. So it's very much data-driven. We look at 5 or 6 different metrics that will tell us if the market's internally weak or if it's internally strong. If it's internally strong, we buy the S&P. If it's internally weak, we sell the S&P. We have another model that tracks the money moving around the sectors of the S&P 500. It's called the SEAF model, S-E-A-F. And that just follows the money, right? Those 11 sector spiders, the ETFs, those represent the S&P 500. So I built a model that calculates how fast the money is moving into or out of those 11 sectors. And we look at it once a week, and it tells us where to be. Like we've been in energy now since the end of July, simply not because, we think oil prices are going up or we think financial conditions are good for the energy business, but just because the money was going there. The money is going there, so we just follow the money. When the money leaves there, then we leave with it and we go somewhere else.
Of course, we want to know more about your technical models, the correction protection model and the Asbury 6. How do they work? Can you show them?
Sure. The correction protection model started I started looking at building a model like that in 2010-ish. It was after the financial collapse. It was after that huge debacle that we had in 2008. And we had clients that were managing other people's money. They were generally RIAs, money managers. And they asked if we could build a simple tool that would tell them risk off or risk on and do it in a way that was following data. Because a lot of these guys, they held throughout the entire collapse. And then when they finally couldn't stand the pain anymore, they sold at the bottom or they sold near the bottom. And then the market turned up. And now they're mad at the market, right? So they're folding their arms and they're saying, you're not getting me twice. So they got burned both times. They got burned on the way down and they got burned on the way up.
We call the violin, like the violin.
Oh, yeah.
We call him the violin. And you buy and it goes down, and you sell, it goes up.
Yep. So I started looking at tactical and strategic tools that have worked for me and tried putting them together in a way where it took the decision-making out of it. You were either in the market or out. And a lot of these clients, the clients of the money managers that I was working for, their clients were older, they were wealthier, and they were more risk averse. These guys wanted to know, how do I play the game with less risk? They weren't looking at trying to hit home runs anymore, right? Or trying to pick the next Apple, but rather, how do these guys play the game and get decent returns, but with nowhere near the risk of holding the S&P 500 through all of this, turbulent times. So we came up with a handful of indicators, and actually we just rebalanced the CPM. Our previous CPM went back 12 years. What I found is once you start going backwards beyond 5 to 7 years, you may be getting an incorrect idea of what your model's telling you because the market changes. Every 5 to 7 years, it's kind of a Ray Dalio, looks at markets this way. he's one of the smartest guys out there. I have huge respect for him. So anyway, so we took our model back to 5 to 7 years and we rebalanced it, and it does quite well. Let me show you a chart.
Please, do that.
So this is, okay, so here's the CPM, and CPM is either risk on or it's risk off. If it's risk on, it's in the market. If it's risk off, it's out of the market. It moves about 6 times per year, so a little more than once a quarter in terms of, the movements in and out of the market. But here's CPM using SPY, which is the ETF for the S&P 500 to trade it, going back to 7 years, right at the end of 2017, and CPM is green, and SPX, the S&P 500, is in blue. And you can see that it sticks pretty close to the S&P 500. It's actually, over this time period, it's outperformed it by about 10%. So you might look at that and say, well, why not just buy the S&P 500? But the important part of this model is the statistics that go along with it. So here's the corresponding statistics for that 7-year period. So you see the total year return is 87 and change for CPM versus 77 in the S&P. Annualized 11.1 for CPM versus 10, let's call it 10.1. But here's the stuff that's most important to me. The maximum drawdown in the S&P 500 during that period, here's maximum drawdown here, you can see my mouse, is 34%. This, for the CPM, it's 20.2%. Standard deviation for the S&P during that period was 17.6, only 12.3 for CPM. Sharpe ratio, 0.81, which is a respectable Sharpe ratio. Beta, of course, it's 1 for the S&P. The beta is 0.58. So what we're doing is what people asked for, playing the game with less risk. So most clients, most of the clients that I have are of my generation. They're guys in their 50s, 60s, some of them in their 70s. Every one of these guys wants to still be able to trade the market, but they understand it's like football, right? You play football different in the fourth quarter than you do in the first quarter. The fourth quarter, you're trying to protect a lead, and you're not maybe taking as many chances, especially if you're the team on top. You're not taking as many chances. You want to get through the game and retain your score. That's what these folks want to do. They want to play the game, still be able to make a respectable return, but not worry about blowing the game in the fourth quarter, right, by taking a huge hit. So that's kind of where my work is. As an older guy, that's where my interest is, right? I want to be able to play the game with less risk. I'm trying to I don't want to hit home runs anymore. I just want to be able to try to grow my wealth and do it in such a way that I sleep better at night. So that's kind of what I'm interested in, and that's really, I think that's kind of representative of what we try to do at Asbury Research.
Okay, and about your other model, you created a sector ETF asset flows, is SEF, and the cross asset relative performance model that identifies sector and asset rotation. How do they work?
Well, the SEF model came about. SEF stands for Sector ETF Asset Flows. So 6-7 years ago, I had built a model that worked very well finding relative performance trends in the 11 sector SPDR ETFs. And something happened about 6 or 7 years ago, maybe 5 years ago. And you guys probably noticed too, if you trade sector rotation, the sector rotation sped up. The rotations were faster, and the trends didn't last as long. 5 to 7 years ago, there were many opportunities where you could buy a sector, like buy technology, and that that outperformance trend versus the S&P 500, it would stick for 1 or 2 quarters. You'd be able to just kind of ride that trend. Everything sped up. And I think because there's a lot more computerized trading right now, there's estimates that 80% of trading is coming from, computer programs. Everything got faster. So I either had to come up with a better way to do sector rotation, or I had to not do it anymore because I stopped performing. I was getting into these trends too late. And by the time I was in the trend and it started to make a little bit of money, it was over and that money went somewhere else. So I built the model that instead of following the relative performance I could see on the chart, it's following the money that is moving around those sectors, those 11 sector spiders, basically looking at their AUMs and watching that money it's kind of like Monopoly, right? When you play the Monopoly game and you're watching that money move around the board, it's that same pot of money that's in the box, right? But it's moving from Boardwalk to Virginia, to Illinois Avenue, and you're playing a Monopoly game. So what we found is that got us into the trends quicker, and using some money management overlays, we were able to get out of those trades faster. So let me show you what the model looks like. It's updated once a week. And here it is. So you can see, so this is updated once a week. And what we did was we came up with a scoring system. So where the money is going to the most aggressively, those have the lowest numbers. And we did it in 3 different time periods. So here is our shortest time period. It's trading. It's 1 week. And then we have our tactical time period, which is 1 business month. It's 21 days. And then we have our strategic, which is 63 business days or 1 quarter. And then, so we're looking at this technique that I've developed to follow the money around the sector spaces. So over the past week, so this is through the end of last week. So over the past week, the money was most aggressively moving into consumer discretionary here, which is number 1 in green, and secondarily into energy, which is number 2. And it was moving out of the healthcare sector here the most aggressively at number 10, and technology at number 11. And then what we do is we add the scores up through the 3 different time periods, trading, tactical, strategic, and we come up with a ranking score. So anything from 3 to 15, 3 is the best that you could get, right? Because they would all be number 1 to add up to 3. But anything from 3 to 15 is favored. Anything from 16 to 24, so here's 3 to 15 in green. We've got 2 5s and a 15. Energy, consumer, discretionary, and utilities, top 3. And then we've got the neutral, which are all of these in yellow, which goes real estate, financials, communication services, materials, industrials, and technology. And then anything from 25 to 33, those are avoids. So the avoids right now are staples and healthcare. And what we found over time is, I'm going to pull up another chart here. We've had some really good results with this. And again, all we're doing is following the money. We're not trying to figure out what the next hot sector is going to be. We're just trying to watch the money as it moves around the space. And bear with me here. Okay, I don't know if I have this. Sorry, guys. I don't know that I have this one. But basically, all I was going to show you is during that period, let me get back to you. For the past, this model has outperformed the S&P over the past 3 years. It's outperformed it 9 out of the past 12 quarters. It's outperformed the S&P by 9 of the past 12 quarters, and it's going to outperform this month. We've only got 7-8 days left in this month, actual business days. So barring something that I don't think is going to happen. It would take something wild to happen here that the model wasn't able to pick up on. It'll be 10 of 13 quarters. So that's another model that, and the beta on that model is like 0.88. So it's a little bit less than the S&P. Standard deviation is slightly higher. And I think the maximum drawdown on this model during that 3-year period is 22.2% versus 25 for the S&P. So the same concept, the same or less risk and better performance. So, and that's hard to do. That's the most difficult thing that I've ever done in the business. How do you make money with the same amount of risk and be able and do better than the market, or stay even with the market for less risk? It's kind of like the magic box. So that's where our interest is, and that's what my son and I do together. Like some dads go fishing or play golf. Jack and I build models together.
Great. So John, what is your current view about the actual market that mega tech caps are outperforming small caps?
That's a really good question. And I was actually talking to my son Jack about this. I think generally these bigger companies are able to weather the storm, whatever that storm might be. If rates go higher from here, and we're going to look at a chart of rates if you like, they're at a really, 430 is a really important level in the yield of the U.S. 10-year note. But I think these larger companies, they have better access to capital. They're less sensitive to rates. Bigger companies are less sensitive to changes in interest rates. And a lot of these big companies just shed a lot of workers over the past 6 months or so. So they're able to maintain their revenue with less expense. But I think, from 32,000 feet, they're able to weather the storm better. Any drastic changes in interest rates, because they're big, giant companies with lots of financial muscle, they're able to handle whatever curveballs that the Fed or the economy throws them, just because they're these smaller cap companies are typically more sensitive to interest rates. They're smaller companies. They don't have the durability to handle the bumps that these big companies do.
Nice. And John, where can our viewers find you online and follow your work on social media? And also, could you suggest some good books?
Oh, sure. The best way to find me is our website is asburyresearch.com, ASBURY research.com. We also have a YouTube channel. Asbury Research has a YouTube channel. I do a biweekly podcast there. It's free of charge, of course. We put samples of our research. It might be a chart there. It might be a clip from a video that I did for our clients after the clients have a good chance to look at it. It might be a TV appearance that I did, but YouTube has a lot of information there. So you could subscribe there free of charge. And LinkedIn, if you want to learn more about me and my background, you can go to LinkedIn and you can kind of see where I came from and how I've come up with our approach to markets. And what was the other question you asked?
Some good books.
Yeah. When I started on the trading floor, I bought Technical Analysis of Stock Charts by Edwards and McGee. I paid $52 for that book, and I was making $100 a week. So you know how much I wanted that book. I still have that copy, actually. I just gave it to my son not too long ago to read. He just signed up for the CMT program. So that one, and then anything by John Murphy. John Murphy was an early mentor of mine. And anything by Ralph Acampora, of course. Ralph is brilliant. He's the godfather of technical analysis, certainly in this country. So I think any of those books, some of them are a little dated. The Edwards and McGee book's a little bit dated, but conceptually, how charts work, what happens to make prices go up and down. That kind of information is in there. I don't think that ever changes.
They are all great books. I have all of them. They are incredible. So, John, what's your final advice would you give to a young trader starting today?
Man, it's so much harder now because you don't have the exchanges, like I did, where you can go to the exchange and not make any money, but it was like an apprenticeship. I think here was my situation. I was out in Chicago, and I'm not doing this for a commercial, but I was out in Chicago. I was on the trading floor. I needed to be with a group of people that had access to books and advice and things that I could learn. So I joined, back then it was called the MTA. So I joined the MTA early on. That's where I met John Murphy. John Murphy came and gave a speech in Chicago for the MTA people. And I made sure that I was on him like glue and asked him to help me, gave me information. So I think for somebody that's not in New York or any of the financial centers around the world, who doesn't have an uncle or a cousin in the business that they can go sit in and do what I did on the trading floor, but maybe do it shoulder to shoulder with somebody because everything's on the screen now. I think MTA, try to make some friends. The people in the CMT, you can tell I'm an old fossil, right? Because I'm still calling it the MTA. But I think that's an opportunity for people around the world to be able to connect with people that all started where they did, and they were looking for information, maybe looking how to get into the business or learning how to manage their family's money better. It's a great resource. I mean, I'm still here after 30 or 35 years of being in the organization. I've got lifelong friends there. I'm going to see Ralph Ekampora over the weekend. So I think dollar for dollar, unless you've got an immediate into the business, that's the next best thing, is joining the CMT Association and trying to make some friends.
And we come to an end of this amazing interview with John Kossar. As always, we want to thank you all, our viewers, for joining us on this journey.
I've been to the CMT Association for 20 years already, so it's a great advice we gave. We also want to say thank you very much to John for sharing his stories and remarkable realizations with us. We hope that his efforts and dedication inspire other traders from around the world.
Thank you, guys. It was fun, and I hope to see you guys again at the next event.
Okay, thank you very much.
Thank you, everyone. We'll see you in the next interview.